Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Firefly Neuroscience.
If you find our talks useful, please consider subscribe, like, and comment underneath.
Okay, so
We have to talk about what happened yesterday right out of the
absolutely. March 4, 2026 was, well, it was an absolute wild ride for this stock.
Yeah, it really was. I was watching the pre-market trading, and it jumped over 60% just in the pre-market alone. It actually hit $1.10.
Which is just massive momentum before the bell even rings.
Exactly. And to put that in context for your portfolio out there, it traded about 75.18% above its previous close.
Right.
And if you happen to catch the absolute bottom of the session, it was trading 122.1% above its intraday low of 68 cents.
That is the kind of volatility that definitely makes you pause.
Yeah, seeing a stock basically double from its daily low is, it grabs your attention.
It certainly does. And that actually brings us to the core mission for you today as you listen to this. Whenever we see a microcap breakout of this magnitude, the very first caution for your wealth building strategy has to be, is this just a typical unpredictable volatility spike, or are we witnessing the beginning of a genuine turnaround thesis?
Because we see those intraday spikes all the time, and they often just fade.
Exactly. So to figure out if this deserves a place in your portfolio, whether you're looking for a quick short-term swing trade or considering a multi-year hold, we need to rigorously dissect the underlying fundamental growth here.
Right.
We need to understand the artificial intelligence moat they're building, and crucially, we have to weigh the bear case risks. It is incredibly easy to get blinded by those flashing green lights of a big rally.
Oh, for sure. The fear of missing out kicks in.
Right. But you have to look past the ticker tape and see what the machinery underneath is actually doing.
I completely agree, because a massive single-day jump doesn't automatically equal a sound long-term investment. So I want to look really closely at that underlying machinery.
Let's do it.
The growth numbers coming out of Firefly recently are, well, they're certainly eye-catching, but I want to understand what they actually mean in the real world. By the end of 2025, they reported a 20-fold expansion of their commercial footprint.
That is massive scale.
It is. And along with that, they saw a 33-fold increase in their brain scan volumes. And we are talking about EEG and ERP scans here.
Yes.
But before we get lost in the percentages and the multipliers, what exactly are those scans in plain English, just so we have a baseline?
That is a great place to start. So think of an EEG, an electroencephalogram like checking the electrical wiring of a house.
Okay.
You place sensors on a patient's scalp to measure the continuous electrical signals happening in their brain.
Just general brain activity.
Exactly. Now, an ERP, an event-related potential, is a specialized extension of that. It measures the brain's electrical response to a very specific stimulus, so like a sound or a flashing light or an image.
Like how the brain reacts when you show it a picture of a face or something.
Spot on. And historically, interpreting these electrical signals has been a very manual, highly subjective process.
Just doctors looking at printouts.
Basically.
Yeah.
Yes. You had specialists staring at squiggly lines on a screen for hours trying to find microscopic anomalies.
Yeah.
It is tedious, and frankly, it's prone to human error.
I can imagine. So when Firefly reports a 33-fold increase in these scan volumes, they aren't just selling more medical equipment boxes.
No, not at all.
They are fundamentally changing how these clinics operate day to day.
Exactly. They are streamlining a major diagnostic bottleneck. And you have to understand the logistics of getting these systems into clinics is no small feat.
Right. Medical sales are notoriously difficult.
The sales cycle is incredibly long. You have to convince the doctors that technology is reliable. Then you have to convince the hospital administrators that it is cost-effective.
Always the hardest part.
Always.
Yeah.
And then on top of that, you have to ensure the IT department can integrate it securely into their existing hospital networks, which is a nightmare of compliance.
So getting any traction is a big deal.
It's a huge deal. And right now, Firefly has 99 commercial users, and they have completed over 10,800 scans.
Wow.
If we look at the year-over-year momentum, the picture becomes quite clear. They achieved a 1,880% increase in partner sites.
Nearly 2,000%.
Right. And simultaneously, they saw a 3,227% increase in clinical assessments.
Okay, that metric right there, the clinical assessments. That tells you that not only are their sales teams successfully getting a foot in the door at new medical facilities, but the doctors are actively utilizing the technology once it's installed.
Exactly. It is not just sitting in a closet gathering dust because some administrator bought it and the doctors hate it. They are using it.
Okay, so doctors are actually using the tech, which is the ultimate test for any medical device. But as someone looking at this strictly from a wealth-building perspective, my next thought is naturally about the money.
Let's talk about the money.
How does a clinic adopting this tech actually translate to the top line? Because the trailing 12-month revenue sits at $783,000.
Yes, it does.
For a publicly traded company aiming to disrupt neurology, that sounds, well, pretty small, less than $1 million in a year.
It is objectively small. There is no getting around that. But in wealth building, especially when you are dealing with microcap stocks, you aren't paying for where the revenue is today.
You're paying for the trajectory.
Precisely. You are paying for where it is going. The quarter-over-quarter revenue growth is a positive 1,075.8%.
Over 1,000%, quarter over quarter.
Right. And if we isolate just the third quarter of 2025, it showed a 30% sequential revenue growth alongside a 10.9% increase in those scan volumes we just discussed.
So the top-line momentum is clearly accelerating month by month.
It is. The scale is happening right now.
I see. So it's about the speed of the growth, not necessarily the current dollar amount on the balance sheet today. But let's talk about the elephant in the room here, the profitability hurdle.
I knew we would get here.
We have to. I'm looking at these margins, and they look pretty bleak. Profit margins are sitting at exactly 0.0% overall.
0.0.
And the operating margin is negative 632.5%. And the return on equity is negative 340.8%.
Those are heavy numbers.
On paper, those numbers look like a disaster waiting to happen. If the broader market turns, a company with those margins usually gets absolutely crushed.
What am I missing here? Is it just a massive money pit?
You're not missing anything. Those numbers are undeniably steep and they carry real structural risk. But you need to understand the life cycle of a hyper-growth tech company.
Okay.
They are intensely burning cash right now for one specific purpose, and that is scale. They are making a calculated, deliberate decision to prioritize reinvestment into their artificial intelligence platforms over generating short-term returns. So it's a feature, not a bug.
In their view, yes. In software and AI, the first mover who captures the most data often wins the entire sector outright.
Winner takes all.
Exactly. They are spending heavily today to capture a market share that they believe will pay off exponentially down the road. It's the classic Silicon Valley model. You sacrifice profits today to own the ecosystem tomorrow.
That makes sense in theory. Prioritize the land grab over immediate profits. But why are clinics actually choosing Firefly over whatever legacy systems they were using before? There must be something driving this specific footprint expansion besides just a good sales pitch.
There is, and that brings us to their competitive moat, which is really the intersection of artificial intelligence and neurotech.
You okay?
The core differentiator here is their FDA-cleared AI-powered EEG and ERP platform. It's called the Clear platform.
I have to ask about that FDA clearance. An FDA 510(k) clearance is brought up a lot in the medical device world. Is that really a substantial advantage, or is it just a standard bureaucratic stamp that everyone gets eventually?
It's a formidable barrier to entry. Oh, absolutely. Anyone who has dealt with government bureaucracy knows it moves at a glacial pace, and healthcare regulation is the slowest of all for good reason.
Right, they have to make sure it's safe.
To get a 510(k) clearance, you have to prove to the FDA that your device is safe, effective, and substantially equivalent to a legally marketed device. It takes years of rigorous clinical testing.
Endless documentation, I'm sure.
Endless. And so much waiting. Any competitor trying to replicate Firefly's technology has to navigate that exact same grueling, expensive paperwork process.
So it buys them time.
It buys them a massive head start. By the time a competitor gets their clearance, Firefly has already been in the market gathering years of real-world patient data. So yes, it is a very real regulatory moat.
So they have the government's blessing, which keeps the quick imitators out of the picture. Yeah. But what actually makes the Clear platform special on a technical level? Why is it better?
The Clear platform utilizes sophisticated machine learning to provide precise, rapid neurological diagnostics. It drastically improves both data quality and processing speed.
So it cleans up those messy electrical signals we talked about earlier.
Exactly. It finds the signal in the noise. And the broader tech and medical industries are taking notice of this. A major validation of this technology is their acceptance into the NVIDIA Inception program.
Oh, NVIDIA. That's a huge name to be attached to right now.
It's the biggest name in AI hardware. When a tech giant like NVIDIA brings you into their ecosystem, it signals to the market that your underlying software architecture is robust and serious.
They don't just partner with anyone.
No, they don't. Furthermore, Firefly is forging strategic partnerships with entities like Healing Maps ABS and Heidelberg University.
Heidelberg is a major research institution.
Huge. And these aren't just press release fluff partnerships either. These are deep integrations that embed Firefly's technology into the broader neurotech landscape.
You know, seeing them build these partnerships is fascinating, but it makes me wonder about the data they are collecting.
That is the real goldmine here.
Because every time a clinic or a university uses this tech, Firefly is gathering more patient information. Does that create intellectual property? I saw a note about them mentioning 15q 13.3 copy number variants, or CNVs.
Yes.
I have no idea what that means, but it sounds complicated and potentially valuable.
It is extremely valuable. A CNV, or copy number variant, is essentially a specific genetic puzzle piece. In this case, it's a genetic variation that researchers believe is linked to various brain health disorders.
Okay.
Firefly is working on mapping how these specific genetic markers affect brain activity using their AI.
Let me see if I can visualize this, because I think it is the key to understanding the wealth potential here for anyone listening.
Before.
Imagine Firefly Neuroscience is building a highly advanced toll bridge.
Okay, I like that.
And this isn't a bridge over a river. It's a bridge connecting the chaotic, misunderstood world of neurological symptoms to precise, actionable medical diagnoses.
Right.
And the proprietary biomarkers they are discovering and patenting, like those specific genetic puzzle pieces, those CNVs, those are the structural pillars holding up this bridge.
That is a phenomenal way to visualize it.
Right. So because they own the AI that maps these specific brain signals, they essentially own the bridge itself.
They own the infrastructure.
Yes, infrastructure. So if a large pharmaceutical company wants to develop a new blockbuster drug for a neurological disorder, they have to prove their drug actually works on a neurological level to the FDA.
They need a hard proof.
And to get that precise data, they have to drive their clinical trials right across Firefly's toll bridge. Every single time a drug trial or a research study needs that specific proprietary biomarker data, they have to pay the toll to Firefly.
Spot on.
And the more biomarkers they map, the wider the bridge gets and the harder it becomes for drug developers to avoid using them.
That toll bridge analogy perfectly explains the high switching costs, which is another crucial moat we have to discuss.
How?
Well, if a hospital or a massive research institution has built their daily workflows and their clinical trials around Firefly's diagnostic bridge, it becomes logistically and financially painful to switch to a competitor later on.
Because you're locked in.
You are totally locked in.
Oh.
You would have to retrain your entire staff, migrate highly sensitive patient data, and potentially halt multi-million-dollar ongoing clinical trials just to swap out the software.
Nobody's going to do that to save a few bucks on a software license.
Exactly. This proprietary data lock-in is exactly what builds compounding wealth over a decade.
That makes total sense. So we have this toll bridge being built, but as an investor, my next immediate thought is who actually owns the company building it?
The capitalization structure.
Yes. If we look at the shares, the balance sheet profile paints a very clear picture of the microcap mechanics at play here. Firefly is a true microcap.
Very true.
We're looking at a market capitalization floating between roughly 9.95 million and 22.1 million, depending on the day's volatility. And there are exactly 13.39 million shares outstanding.
Which is tiny.
That is a remarkably small company in the public markets.
It is incredibly small. It is essentially a tightly coiled spring. And the ownership structure explains why it sprang so violently yesterday when it jumped 60%.
Break that down for us.
You should be paying very close attention to this dynamic. Insider ownership is remarkably high at 33.95%.
Over a third of the company.
Yes, the executives and the early backers who are building the toll bridge are holding on to their shares. They aren't selling. Additionally, institutional ownership sits at 10.85%.
And that institutional piece is growing, right?
It is, and it's being actively supported by their recent addition to the Russell Microcap Index.
Let's unpack that index addition, because I think a lot of people see added to an index and assume it just means prestige or good PR.
It's way more than PR.
Why does being added to the Russell microcap actually matter for the stock price itself?
It matters because of algorithmic buying. When a stock is added to a major index, like the Russell mutual funds and exchange-traded funds that are designed to track that index are structurally forced to buy shares of the company.
They don't have a choice.
None at all. It doesn't matter if the fund manager personally likes the stock or hates it. The algorithm demands they buy it to match the index weighting.
So it creates automatic built-in demand.
Exactly. But here is the critical part for you as an investor trying to build wealth. Because insiders and institutions are locking up almost half of the total shares, the public float is severely restricted.
For anyone new to trading, what exactly do you mean by the public float?
The float is the actual number of shares available for regular retail traders to buy and sell on the open market on any given day.
Okay.
Imagine a highly anticipated concert in a small venue. The venue holds 1,000 people, but the band, the VIPs and the promoters, have already claimed 450 of those tickets, and they refuse to sell them.
Right, they're holding them.
That leaves only 550 tickets for the general public.
Mm-hmm.
So when thousands of fans suddenly decide they want to go to this concert, they're all fighting over that tiny pool of 550 tickets. What happens?
Scalpers drive the price to the moon.
Exactly.
Oh, I see. That is exactly what happens with microcap stocks with high insider ownership. When a major catalyst hits like the news of a 20-fold clinic expansion, a massive wave of new buyers rushes in.
Yes.
But because the supply of available shares is so incredibly low, buyers have to bid the price higher and higher just to get a piece of the action.
Precisely. High demand meeting a severely restricted supply is the exact mechanical setup that creates these violent upside moves on high volume.
That perfectly explains the momentum shift we saw. Because honestly, looking at the chart before Wednesday, it was grim.
It was not pretty.
Not at all.
Yeah.
The stock had suffered a brutal one-year decline of over 84.3%. It was beaten down and frankly forgotten by a lot of the market.
Very true.
But Wednesday's massive volume and the sheer size of the gap-up activity signals a classic bullish breakout pattern. Technically speaking, though, does a single move of this magnitude really override the prior year of painful year-to-date declines?
From a purely technical charting perspective, yes, it does. It acts as a hard reset on the chart.
Just wipes the slate clean.
Functionally, yes.
Yeah.
The sheer volume of shares traded validates that upward move. But as an intelligent investor, you cannot just look at the hard reset and the cool technology without doing a rigorous risk assessment.
We have to look at the downside.
We have to weigh this bull thesis against the very real bear case. It is our job to make sure you have a balanced view of the board before you risk your capital.
I appreciate that because it is so easy to get caught up in the hype of a 60% rally and an AI toll bridge.
It really is.
Let me play devil's advocate for a moment then. If I'm looking for reasons to be cautious, the first thing blaring like a siren is the valuation multiple.
The EV to revenue.
Yes, the enterprise value to revenue multiple is sitting at 86.89 times.
That is steep.
For anyone new to that metric, enterprise value is essentially the total price tag of a company. It adds the market cap and the debt then subtracts the cash. It's basically what it would cost to buy the whole operation outright today.
Right.
When you compare that total price tag to the actual revenue coming in the door, a ratio of almost 87 is sky high. Value investors typically look for multiples in the single digits.
They do.
This means the market is pricing in years of future flawless execution right now today. Any misstep in that valuation could completely collapse.
You are absolutely right. An EV to revenue multiple of almost 87 times leaves zero room for management to stumble. The expectations are sky high.
Right. And going back to what we discussed earlier about them burning cash to scale, if that cash runs dangerously low before they hit actual profitability, investors are exposed to severe dilution risks.
That is the big fear with microcap.
They will have to issue more shares to keep the lights on. It's like taking a pizza and cutting it into more slices. Your slice just got smaller and less valuable. Furthermore, if you look at historical analyst coverage, the consensus leaned heavily toward a sell rating with a literal $0 price target.
Ouch.
Yeah, $0. And before this breakout, we only saw about 33% of trading days closing in the green. It has been a painful, volatile ride for anyone holding.
Those are highly valid structural risks.
Mm-hmm.
The cash burn is very real, and dilution is always a looming threat with unprofitable microcaps.
So how do you justify the bull case then?
I am going to counter that with the ultimate bull thesis, which earns a solid 7 out of 10 bullish score in our assessment.
A 7 out of 10 is strong.
It is. Yes, the profitability gaps are stark, but the 1,075% quarter-over-quarter revenue growth proves that a massive scale inflection point is happening right now.
It's not just a theory anymore.
Exactly. They aren't just burning cash on theoretical ideas or fancy corporate offices.
Yeah.
They are burning cash to install diagnostic machines that are immediately generating exponential revenue growth.
So the spending is actually resulting in tangible, measurable adoption in the field?
Yes. Furthermore, the 60% rally shows that the broader market is finally digesting this operational progress and actively pricing it in.
The market is waking up to the data.
Right. And to address your fear of dilution, that extraordinarily high 34% insider stake heavily mitigates the risk of a sudden reckless share offering.
Because they would be hurting themselves.
Exactly. Insiders are not going to dilute their own substantial holdings into oblivion right as the commercial rollout is catching fire. Their financial interests are directly aligned with yours as a shareholder.
Okay, so the incentives are aligned, which is always reassuring. That makes the timeline moving forward crucial. If you are listening to this and thinking about taking a position, what should you be watching over the next 3 months?
The immediate upcoming milestone is earnings.
Always.
Currently, there is a lack of a confirmed Q1 2026 earnings date on the calendar. However, the sheer momentum they demonstrated after the third quarter of 2025 perfectly sets the stage for potential scan volume beats when those numbers are eventually released.
So watch the volume numbers closely.
Very closely. You should also be actively watching for potential follow-up announcements regarding the Heidelberg University biomarker study.
Right, the proprietary data.
Yes, and any expansion of their collaborations with NVIDIA. Any news on those fronts could act as a major upside catalyst.
We also can't ignore the macro environment, right? The broader market wins seem incredibly relevant to a stock like this.
They are very relevant. We are seeing speculative catalysts aligning perfectly for Firefly right now. There is a broader sector rotation happening in the market where capital is flowing heavily out of traditional tech and into AI health initiatives.
Following the AI trend into healthcare.
Exactly. On top of that, we are currently in an environment of low interest rates.
Which is huge for small companies.
It fundamentally favors microcap growth stocks because they often rely on borrowing money to fund their rapid expansion. When interest rates are low, the cost of that capital is cheap, allowing them to grow faster with less financial strain.
Makes sense. And then, of course, there are the rumors.
The rumors, yes.
There is growing speculation that there's supercomputing AI data, that massive repository of proprietary brain biomarkers they are accumulating could make them an attractive mergers and acquisitions target.
The M&A speculation makes logical sense when you step back. Large healthcare and medical device companies are notoriously slow to innovate internally.
They prefer to just buy innovation.
Exactly. If a larger medical device player wants to instantly own the premier AI toll bridge in neurodiagnostics, buying Firefly at a microcap valuation is a highly strategic move.
It's a bargain for a giant, like Medtronic or Johnson & Johnson.
Right. It is often much cheaper and faster for a massive corporation to buy a smaller innovator than to try and build the technology, get the FDA clearances, and secure the patents from scratch.
So let's bring this all together into the elevator pitch for the listener. What is the ultimate wealth-building takeaway for you today?
I would summarize it like this.
Go ahead.
Firefly Neuroscience's explosive commercial and scan expansion validates their AI-powered EEG moat. They are proving that the demand for their technology is real, and doctors are actually using it daily.
Which is the hardest part.
For you, this stock represents a unique vehicle to turn standard microcap volatility into genuine multi-bagger potential, provided, of course, that you're getting it ahead of that ultimate profitability inflection point.
It's all about the timing. As for your target horizon, you really need to view this through two distinct lenses to manage your risk properly.
Exactly. First, this sets up beautifully as a highly dynamic swing trade into the Q1 earnings release over the next 3 to 6 months. You are riding the momentum of the breakout and the anticipation of volume beats.
But you shouldn't just look at it as a short-term flip.
No. That swing trade should be mentally paired with a multi-year hold thesis. If you believe in their path to artificial intelligence, neurotech dominance, you hold a core position to capture the long-term value of those proprietary biomarker discoveries.
And the potential M&A upside we discussed.
Decisive.
I think that dual horizon approach is the absolute smartest way to manage the risk while keeping yourself fully exposed to the upside potential.
It really is the balanced way to play it.
As we wrap up today's analysis, I want to leave you with a final, slightly provocative thought to mull over on your own.
Leave them with something to think about.
As you look at companies bridging the vast, complex gap between artificial intelligence and the human brain. Ask yourself this. If a company maps enough proprietary brain biomarkers, do they eventually stop being just a diagnostics tool and instead become the ultimate unavoidable data gatekeeper for every single neurological drug trial on Earth?